identifying a good company is not the same thing as identifying a good investment, because you need to know what is the price you're paying for the set of future cash flows. So I think those are things that's good to always remind investors, and so that they're not constantly looking at headlines and then reflecting those headlines in their investment decisions. So if you look at, for example, our commingled funds that are in the US, and they are investing in different regions, in global portfolios, US equities, and so on. For those funds that are, I'd say, launched 20 years ago, all of them are still around. So the survivorship is 100%. Never been a better time for global investors today, because now with the technology, with the infrastructure, you can actually get more than 10,000 stocks in your portfolio at a very minimal fee. Previously, it's probably not possible. The most important thing about your investment philosophy is that you have one that you can stick with.
What is your performance look like? Welcome back to Chills with TFC. I'm your host, Reggie, aka your Chief Financial Coconut, and I know the world is going crazy. Many things are happening, and all that stuff, right? The bombs, the markets, and all those pretty intense things are happening. So I wanted to let you know that we are recording this on the 17th of March. We don't usually do that, so you don't kind of know when we record. But I think for context, it is important to know that we are recording today's episode on the 17th of March, and we'll try to get it out to you as soon as possible. So I am very excited to be in studio with Wei from Dimensional. She's the global head of research, to talk a little bit about what she does, what do they do in general, and then try to contextualize all that perennial truths and wisdom into today's crazy markets. So yes, for our audience that don't know you, maybe you could introduce yourself.
My name is Wei. I've been on the research team since 2014, so more than a decade ago.
How do you stay for a decade?
Well, I was saying that's the review of preference, right? Part of me is really nerdy. I like to do research, crunch numbers, but part of me really like to talk to clients about what we do. So I think Dimensional definitely provides that best of both worlds for someone like me, to be able to do rigorous research, academic quality research, but then to be able to also apply that research in real life, and then to explain to investors who actually, in the end, use our solutions. So I guess that has been what kept me busy and, happy here. Yeah.
Great.
I started in the headquarters in Austin, Texas, and I moved to Singapore back in 2019. So stayed here for more than 6 years. Just earlier this year, relocated back to our headquarters in Austin, Texas.
That's why you're now the global head of research, right? But what does the global head of research actually does? Give us a glimpse into your life and all that.
For us, we have a global team. We are a global firm, right? With 16 offices across the globe, and we have a research presence in many offices. So Singapore being a good example. Essentially, the researcher locally will interact with clients in the Asia ex-Japan region. And then in the US, we have 3 offices, Austin, Charlotte, and Santa Monica, and we have research presence. And then in EMEA, so we have the talented folks in the London office and taking care of clients there. So in terms of what we do, I think of us as having a kind of global research agenda. So of course, the researchers do very different things at different asset managers, right? So I think we'll get into our philosophy and our research-driven approach. So we have a global agenda, meaning that it's not like, our researchers in Singapore will only look at Asian companies or China, right? China A-shares of that nature. We are looking at systematic return drivers that are applicable across the globe that we can build our portfolios around. So our research is really about identifying those systematic return drivers that we can build our portfolios around, but also doing a lot of research on the more practical side, thinking how you can actually translate those research insights into real world portfolios. And then a lot of that is also about implementation expertise, how you actually deliver that excess return in the real world. But then I think it's so helpful to have local presence because then we get to actually talk to clients locally, knowing what's on top of mind. And then you see a lot of commonalities too, but being able to actually serve our clients locally is a very big part of what we do as well.
Okay. That's a very long way of saying, all these smart people report to me. we try to come together to understand what's going on in the world, and then profess certain investment ideologies. Right?
I am grateful for all the talented people I get to work with. I think that's actually the big part of why I've been with Dimensional for so long, because I feel that there's always people around me who know a lot more about things that I can learn from.
Maybe kind of give us a little bit of the lay of the land, right? Like, what is the core ideologies of Dimensional? Like, what do you believe in? And after crunching all the numbers and the stats, what is the philosophy?
Yeah, absolutely. And I think that's a philosophy we've held since day one, back in, the founding of the firm in 1981. And if you think about this financial market, there's no shortage of incentives to kind of give you the flavor of the week. And then there's lots of new, some are investment fads, some new products.
Long enough, you see tons of this.
Yeah, exactly. Kind of things come and go.
Yeah.
So I think, it's actually been quite unique for a firm like Dimensional to be able to stay true to our investment philosophy and to be committed to our investment approach since day one. And that is a philosophy that is rooted in financial science, that's driven by research, backed by a lot of the academic and in-house research we do. But then ultimately, the philosophy goes back to how markets work, right? We believe that with so kind of in very liquid and competitive markets, prices are essentially the hero of our story, meaning that we think prices contain a lot of real-time information and the forward-looking expectations of markets. So just to unpack that a little bit, if you think about buyers and sellers coming to the market, they agree on the price to buy, right? And then that information gets into market prices very, very quickly. So that's why we always say that market prices are forward-looking. For us, our philosophy is that we believe that markets work. Markets do a good job at incorporating information very quickly. So our way of adding value and to construct our portfolios is not try to figure out where securities are mispriced or try to time the market, but actually try to extract information from market prices that are about differences in expected returns. So we can then structure broadly diversified, low turnover portfolios that do better than the market, but in a more reliable and more cost-effective way. So in a way, I think your listeners may be familiar with, say, traditional active investing and then, say, passive, pure index tracking investing. So in a way, I think of our approach, and we like to say we are systematic active, so we can maybe get into the terminology there.
But key terms, yes.
But in a sense, it's trying to combine the best of both active investing and passive investing. So just like pure passive funds, we are very broadly diversified. When I say diversification, I'm talking about tens of thousands of securities in our global universe. And we have very low turnover, we are transparent, we are rule-based. Those are all the great things associated with pure passive approach. But unlike passive, our goal is not just to match index return and minus fees, right? We try to outperform. So that's where we are getting that benefit of active investing. But we're not trying to do so through trying to, say, outguess the market, trying to exploit mispricing, because there's not a lot of evidence that people can do it consistently and reliably. So our way of outperforming is through a research-based approach and to identify those systematic return drivers in different markets.
So what are these drivers? Because it sounds too good to be true. We're not trying to catch mispriced markets, we're not trying to do all this. What are, in your core universe, right, all these systematic like drivers?
Just to begin with, and then I'll talk about within equities.
That's a whole series. Yes.
Just to begin with, if you think about stocks versus bonds, right? Say equity markets versus T-bills, which one do you think have higher expected return?
Equity.
Exactly.
Yeah.
So that is a systematic return driver, right, between different asset classes, and that's the equity premium. When I say premium, we're not talking about insurance. We're talking about the excess returns between different groups of securities. So here, you can already see that the market, incorporate information very, very quickly, but doesn't mean that all securities out there should have exactly the same expected return, right? You already told me that stocks should have higher expected returns than bonds. And similarly, say within bonds, or if you think about trying to get a loan from a bank, or you try to lend money to your friends or colleagues or different people, you probably charge different interest rate, right? So it's very intuitive to think that it would be actually be odd if all securities out there have exactly the same expected return, right? So it's natural to think there should be differences. So then how do we identify those systematic differences? Now, within equities, our starting point is to think through that valuation framework. It's actually quite straightforward thinking. If you look at the price of a stock today, where you get to see where things are traded at, what does that represent? Well, that represents the future cash flows that you are entitled to as investor, but those are happening in the future. So you discount it back to today's value. So that discount rate from our investors' perspective is our expected return. And from a company's perspective, that's their cost of capital, right? So basically the expected compensation that we're entitled to by providing capital. So then that framework then tells you have price and future cash flows and discount it back. What then drives that discount rate? It's the price you pay. It's the future cash flows you're expected to receive. That's as simple as that. That applies to any investments, right? I sell you a watch. You ask me how much I'm paying and what I'm getting, right? So it's the same thing with buying securities. So that's why in terms of the factors or systematic return drivers we pursue, two of them are related to prices. So one is the market capitalization. Smaller cap companies, all else equal, should have higher expected returns than larger cap companies. And two, relative price. So instead of doing price times shares outstanding that gives you the market capitalization, we do price divided by some fundamental, so say price to book. So those companies with lower relative price, they should have higher expected return than companies with higher relative price. So those are two price-related return drivers. And on the other side of the equation, we have future cash flow related return driver. And in particular, we focus on profitability, right? Because the future cash flows, a big part of that is the profits that companies are producing. So we see that companies, of course, you don't get to see future profitability, but today's profitability is actually a reliable proxy for future profitability. And that's what research kind of shows, what is a good way to find a reliable proxy for future profitability. So then companies that are highly profitable, all else equal, should have higher expected return than companies with lower profitability. So in short, we are focusing on size, value, and profitability, those three being the main drivers of expected returns on the equity side. And then there are shorter term signals we use as well.
So discounted cash flow, that's if you're in the space, you kind of get it, right? Okay. And then profitability, okay, that I kind of get it. But based on the thesis, right, that you're going with, I have two questions to go with. And one is value trap, right? Like how do you kind of capture within your data sets that this is a value trap, right? As opposed to like, this is undervalued, right? Like we can go in. So this is one question. And then the other question about profitability, right? So I think over the past decade, most of the so-called most profitable companies, they all started like not very profitable, right? And then there's a lot of cash burning exercises that go through that process of growth before they turn a profit. So and that bit of that process, how do you even know who is going to eventually become like madly profitable? Right, there are definitely a lot of assumptions in the fundamental analysis of the company.
Because in the end, we're trying to find those systematic return drivers. And you may ask, well, why are there differences in discount rates? And it goes back to our philosophy. We think, well, there can be differences in risk, differences in taste and preferences that are driving those differences in discount rates. And in the end, you probably don't even need to know what exactly is that underpinning reasoning, because that's actually a very important topic for academics that the kind of jury is still out. But then when it comes to, when you're thinking about value trap, that's actually where profitability can be very, very helpful in that context. Because I think you're right. If you're thinking about a valuation framework, the valuation can be low because discount rate is high, right? But valuation can be low because future cash flows are low, right? So that's what probably you are thinking about in terms of value trap. So in that sense, profitability is the other side of that equation that helps you to make your valuation or your prices more informative, right? So now we're looking at not just valuation of companies, but also future cash flows through profitability lens. So that helps us together, gives us more information about the expected return and help us mitigate some of the value trap situation. And then also earlier, I talked about some of the short-term return drivers that we are looking at. Some of that has to do with the recent performance of securities. So for example, momentum being a short-term signal that we use for companies that have done really poorly in recent, say, 6 to 12 months, then they continue to underperform. And so that's another signal that we might use. And then you could say that that could be related to the deterioration of some companies and, and then you see how things are coming down. So we try to kind of not to catch the falling knife, right, through a signal, right? So that's another way to think about value trap as an example.
Okay, maybe we give some like case scenarios, right? So I think the Chinese market has been baffled down, over the course of the past like 5-6 years, and then there's this underpinning idea of like value, right? Like okay, so a lot of the companies that are sold through, they do very good, future cash flow. They look pretty healthy, but they are trading at like 10 to 12 PE, right? So like, is that kind of a situation where you would take that same lens and say like, okay, it is sold down, but the future profitability looks pretty healthy, and it is a case that you can evaluate, but then you don't want to catch a falling knife, so you hold out for a little longer before you look at it? Just try to understand that.
Yeah, because in the end, what we are looking for are systematic relations, right? It's not going to be looking at individual companies. So it's all about relative relation, and then we actually do those comparisons within each market. We're not doing any, say, country bet and say, okay, this whole market is having higher expected returns or lower expected returns. We don't think there is any reliable evidence to make those predictions. And then, regardless of the level of the market, within each market, you always have companies that have higher relative price versus lower relative price. You have companies with higher profitability versus lower profitability. And you can do those essentially we do those three-way sorts, right, on those characteristics. And then you can identify those companies with higher expected returns. Of course, then, we have done research specifically on individual markets. We have looked at, China A shares, H shares, and so on. We actually have seen that the same premiums, basically those return differences, they are healthy and then sizable in those markets as well. And of course, when you think about the realized returns, that's where, you can always have the realized excess returns being negative. And especially if you slice and dice and look at only a particular market or a particular segment, you can always come up with stories, say, okay, why this is no longer working. But I think it's always good to come back and say, well, we know the expectations are positive because of the valuation framework and because of almost 100 years of data we now have. But at the same time, we know that the realized returns are going to be noisy. Same thing as I asked you about equity premium, right? Stocks should outperform bonds on expectation. Well, we have plenty of years stocks underperform T-bills, right? That shouldn't change your expectation that equity premium should be positive. I think is true with some of the premiums that we target in our portfolio size, value, and profitability. Of course, there are periods the premiums might be negative. We have seen that, for example, challenging period for the size and value premiums in the US as well, right? Given the outperformance of the Max 7 of the world. But that doesn't change our expectation that those premiums on expectation should be positive.
I understand broadly what you're talking about. So we zoom out, okay? We don't look at like individual, asset class or like certain geography, right? You want to make sure over the long course of time you keep hitting, right? Because you can always make a good windfall for a few years and then the whole thing changes, right? So structurally you want that prolonged period, and I think that underpins the ideas. So has some of these like systematic drivers change over time, within your system? How does that kind of come along? Maybe just give me some ideas.
That's what kind of keeps our team busy, and then the whole investment team busy, is to always kind of be on top of the development out there and constantly doing research on what can be additive to our current investment process. And to do that, the research standard we set is actually quite high.
Of course, you have to say your standard is high.
It's not shaped just by me, but actually shaped by the whole kind of the academic heritage we've had since day one. So if you look at the academics that we've been working so close with, many actually since day one, they are the essentially the brightest minds in factor investing world. You're talking about people like Professor Jing Fama, Ken French, Professor Robert Novi Marks, Bob Merton. They are the ones who actually made those milestone contributions to asset pricing, to factor investing. And everybody in the factor investing world would read their papers. But the company they are associated with is dimensional. So we get to actually work very closely with them. Of course, we benefit a lot from their insights and being able to collaborate with them. But it's also a very scary process because all of our work will needs to be scrutinized by a crowd like that. So going back to what you're saying about, identifying anything that we want to do to enhance our portfolios, we've always been enhancing over time. But we are not in the business of trying to say, I'll come up with a new factor every single quarter or tweak our portfolios all the time just to, sound new.
So you sell new thing, right?
Yeah,
I
exactly.
get it.
And
I
then
get
that
it.
actually requires a lot of discipline. And then it goes back to that anything that needs to will be added to our portfolio will go through the so-called investment research committee, which is chaired by our co-CIO, but also attended by these leading academics, many of whom actually won Nobel Prize, right? So that we work with. And that's why if you look at the track record of the factors in our portfolio, how they have changed over time, we've never had a case where we had to kind of say turn off a factor and say, sorry, it actually didn't work. Or, we actually, didn't get comprehensive analysis and then now we think differently. So I think the track record of our own funds actually matches the track record of our research, that long-term purpose. But doesn't mean that we're not making changes over time. So over time, we've been adding those factors to our portfolios and making enhancements over time. So for example, previously, since day one, we started with just a microcap strategy. And then we have multi-factors, size and value. And then with Professor Robert Novi Marks' work and a lot of our in-house work, then we incorporated profitability. And then there's a lot of shorter term drivers that we incorporate into our portfolios as well. One of the most recent ones is actually a collaboration with Professor Robert Novi Marks on short-term reversals. That's really about kind of the liquidity provision in the market and how the very short-term performance of securities give you information about also very short-term future performance. So that's another short-term signal that we use in our investment process. And currently, we're doing a lot of research on, you asked about profitability. So right now, we're using the current profitability as a proxy for future, right? But then there's also changes in profitability. So we're looking at profitability growth as a potential return driver that can be used to enhance our profitability proxy. So we're always looking, but then I would say that those big changes don't come along every single year.
Then let's take whatever that you've shared in the front part, which is great, thank you, to try to contextualize on what is happening today, right? Like in the current market, with all these oil situation, oil prices going through the roof, and with bombs happening in the Middle East and all that. And why? Because with all markets, there's this thing called market failure, right? There's always a part where you kind of can't factor like this thing is a black swan event, or this thing is like, or maybe you can, it's like you can't prepare for those things in my understanding. So they are like, what? You mean this thing just happened, right? And then how would you, from your point of view, evaluate the current situation, and how does that then inform your investment ideas?
I think it's tempting to say, well, every time is different. And it is true, right? There's always some novelty to, what is happening in the world. But I would say that fundamentally, investing is always about embracing that uncertainty, right? So if you think about what we do, I would say there's the kind of the philosophy part, right? That part is evergreen and doesn't really change just with different events going on or different market cycle. But there's also the implementation side, how you actually access the market, how you trade, that you do need to pay attention to, the cost and then also the volatility in the market. So I would say I will address that in both ends. In terms of our philosophy, if you think about what we're doing, we're not relying on a crystal ball about the future, because I don't think anybody really has that in a consistent manner. So that's why we rely a lot on real-time market prices being the hero of our story. So if you think about what's going on with geopolitics, with right different state of the economy, all of that expectations and range of outcomes are constantly changing and reflected in real-time market prices. That's why it's even more important now to rely on market prices being the forward-looking guidance for investment process. And then that is a fundamental principle that is true regardless of the state of the economy and where you are in the world. And I think that philosophy has served us really, really well. And then we have also been talking to our clients that you want to, because you cannot really predict what can happen, right? So that's why you want to build your portfolio that is prepared for what can possibly happen. You cannot predict what will happen. Yeah. So being broadly diversified, that is your first line of defense. And then having a portfolio that's integrating multiple sources value add instead of just doubling down on one return driver, but integrating multiple of them, that helps a lot with mitigating some of the downsides as well. And then ultimately, I think for investors, very important to stay disciplined through those ups and downs. I know it can be very tempting to get out when things are uncertain or whenever there's a downturn. But oftentimes you're making essentially realizing those losses and not coming back and then kind of missing out on the rebound. I think they're good to understand that there is a difference between what is happening in the real economy versus what is happening in the financial market, right? It's very easy to say, well, of course they are linked, and they should be, but what is happening in the real economy can take months or decades, to unfold. And then the thing about the financial market is that it makes you feel the pain and joy instantaneously, right? So that's why not trying to link the two to make your financial decisions is quite critical. Because if you look at, what the stock market performance say after the onset of, say, a recession, we see that the majority of times market's actually up 1 to 2 years after recession. So even if knowing that you are deep in recession will not really be helpful for making investment decisions. And same thing with thinking about individual companies. It's different. You can make all the predictions about how the company will be impacted by the events in the world and how that may impact their balance sheet and income, down the road. Yeah, that is all fine. But identifying a good company is not the same thing as identifying a good investment, right? Because you need to know what is the price you're paying for the set of future cash flows. So I think those are things that's good to always remind investors, and so that they're not constantly looking at headlines and then reflecting those headlines in their investment decisions. So that part we are not changing. But in terms of every day, we do have a daily investment process. We're very closely monitoring what the market is doing and what is the liquidity like in the market. And then we have portfolio managers across the globe actually looking at whether today is a good time to trade or should we take a step back, and then to make sure that we're not constantly, say, incurring turnover and costs when things are very volatile. So how you actually access the market, how you implement to make sure you're not spending unnecessary costs to rebalance your portfolio in on not the best times, that's actually more important on a daily basis.
Hey, welcome to the Financial Coconut Podcast Network. I'm your host, Reggie, aka your Chief Financial Coconut. And if you're loving what we're creating here, like, share, subscribe, share with your loved ones, comment in the comment section below. And yeah, we'll see you for great content on Chills with TFC. If we try to contextualize to what's happening now, do you have some thoughts and wisdom for us? With oil prices going up and and all that. Do you have some things for us to work with?
I think still the best way to kind of go through periods like that is to be globally diversified and to be disciplined.
That's a universal wisdom,
yeah.
right?
And then of course, I think periods like this is actually useful for investors to understand their own risk tolerance, because in current periods, if you ask people, what is your risk tolerance, it's a very abstract thing, right? They may think, okay, I will be fine even if my portfolio is down by 20, 30%. But when that actually happens, they might feel very differently. So we actually encourage clients to think through those periods. And then if the recent events tell them something new or make them realize what their risk tolerance actually are, then they should reflect that in their asset allocation. And those should be kind of more permanent changes instead of saying, okay, now I'm reducing my equity allocation just because market is volatile. So that's more reflecting their understanding of their risk tolerance. So it's fine to make those adjustments, but make sure you're making those adjustments for the right reasons.
The internet talks about all sorts of stuff, right? So there's I'm gonna ask you one question that I've asked a few people, just so I get some thoughts from everyone, right? So I think one thing that people are talking about is this whole de-dollarization, situation, right? Which I think it ties to everything, right? It ties to the whole the US fall of the empire and blah 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 blah. So that's what the internet talks about, right? But the markets have a very different view, right? And I've talked to different people around this, right? So I want to put this to you to help us understand how do you look at this thing, right? In terms of the future of the US dollar, how does that affect your investment? How does that look like?
I'll not pretend to be a macroeconomist
On that
on that front,
Yeah.
but I can share the research we have done at that front, just in terms of currency movements in general, USD included. Are they predictable? And we have done a lot of research there to show that, in the end, short-term currency movements are largely unpredictable. So so that's why we don't really make any, say, currency bets in our portfolios. Now, for investors, that actually has important implications. If currency returns are unpredictable, then what are the impacts on currencies on your portfolios? Of course, that means you're holding a global portfolio, right? Which is a great starting point. If you're only kind of in your domestic equities, you don't worry about that, but then, you're not properly diversified. So then the impact of currency movements on your portfolios very much depends on your own asset allocation. So currencies, by and large, are kind of similar in terms of volatility as equities, and much more volatile than fixed income. So it should be very intuitive that if you have an equity-heavy portfolio, then your overall portfolio volatility is pretty similar with if you do currency hedging or not. Right, so that means for a lot of our global equity portfolios, our default is just to leave currencies unhedged, because overall portfolio volatility is really driven by the majority of your equity allocation. In contrast, if you have fixed income being your majority, then you're going to have big swings, and then our default is to be, to hedge back to the base currency. So I think those are the more tangible aspects for investors to think about. Instead of being fixated on a particular currency and how that will move, think about the impact on your overall portfolio and think about the aggregate kind of more holistic view in terms of your expected return, in terms of volatility. I think that will serve investors better.
I think that's kind of where the question is coming from, right? Because many people have made good money investing in the US markets, and so there's I'm not so sure if this is a fair statement, but I think it's okay to say that there's quite a tilt to the US markets, at least for a lot of the people that spend all their hours on the internet, right? So there's a lot of focus there. And I think that's why that underpins that fear of what if the US dollar, continues to depreciate over time, and
maybe related to that, we hear, previously, S&P 500 is kind of the darling of the world. You're like, why would you invest anything but?
Yes.
And then you start to hear, kind of last year, the end of US exceptionalism, right? It's kind of interesting how those headlines rotate just based on recent performance. So I think that's actually a good reminder for thinking, well, the current market capitalization is giving you that instantaneous snapshot for the trade-offs between expected return and cost and volatility. Would typically encourage investors to think about using the market weights as the starting point to think about their regional allocation. So naturally, you will have the majority, say 60% in the US, and then you have developed ex-US, and you have emerging markets. So that is pretty natural. But then we do get a lot of client questions about, now US being such a big part of the global market, and US itself is so top heavy. Although the level is not something we haven't seen before. It's more kind of in recent decade, you have seen that kind of coming up in terms of top 10 weights, let's say. And then also valuations are so high. So what are the things you can do to try to mitigate some of the, say, concentration concerns or valuation concerns to the extent that you are concerned about it? One thing we've been talking to clients about those is, one is that kind of traditional active is not kind of reliable way to do it. And then you start to hear people talking about, say, equal weighting or some of the, say, quality indices. And we see those also be kind of two mechanical ways to try to bring down the weights in individual stocks or to try to get the more bang for the buck for your valuation. So again, of course, I'm biased. If you think about systematic active, we actually, it has that built-in mechanism. If you're tilting towards size, value, profitability premiums, naturally you're tilting away from mega cap growth stocks, right? So your top weights will come down. And if you can do that across the globe, that helps even more, right? So now instead of having, say, 30-40% in your top 10 weights, you might come down to 20 or even in terms of teens. So that's a lot more manageable. So we have some of those kind of materials we shared with clients. Those have been quite compelling.
That is interesting. Okay, maybe one more on the recent situation, right? So I just want to get some thoughts around oil prices, right? Because I think it's driving anxiety amongst the people, right? I say, of course, as a consumer, you will feel it, right? But as an investor, how does that inform, the portfolio? So let's say if we assume, of course, we can't, right? But just to kind of put it out there, which is if oil prices were to stay elevated over the course of the years to come, that means we're no longer getting cheap oil, right? That means there's all sorts of repercussion that will happen to the fundamentals of companies, right? So how do you kind of look at this thing, and how should I look at this thing from your point of view, where oil prices stay elevated, and how does it inform portfolios?
So in the end, of course, they're going to have an impact on some companies and on the overall economy. But going back to what I said earlier, if you are asking about this, if everyone is looking at it, those expectations are built in. They are built in, right?
You're late.
When we talk about, right, making those tactical moves, why it's difficult, it's not so much that you, basically, even if you come with the correct prediction, that's not enough. What you need to know is how your prediction differs from the expectations that are already built into market prices, right? And whether you have more information and more insightful than the collective wisdom of the market. So that's why I think I wouldn't, encourage investors to try to, predict where oil prices are going. But I would say that, of course, oil prices and so on can have a big impact on, say, potential inflation. So we have looked at, say, the relation between inflation and as global asset returns. And we actually looked at periods with high inflation versus low inflation. In the last few years, inflation has been top of mind for clients. So I guess the good news there is that regardless of high versus low inflation, the typical growth assets, thinking about equities and fixed income, they have outpaced inflation over the long run. So they have been helpful for you to basically retaining and growing your purchasing power. So that's the good news. Maybe the more cautionary tale is that whenever inflation is up, people ask you should be hedging inflation, right? You need to look at assets that kind of move closely with inflation. We have looked at things like commodities, right? They do have positive correlation with inflation, but commodities themselves are so volatile, right? That's even more so than aggregate equity market. They're just not a great hedge. So be careful when people kind of say, well, you should then go into commodities for inflation hedging. If you do want to hedge inflation and really move kind of more in lockstep with realized inflation, then you should look at instruments that are designed to do so. So inflation protected securities or having inflation swaps. Of course, the availability of these securities and the pricing of them may be different across markets, but at least, don't fall for particular, hedging when it actually doesn't do the job.
Of course, you don't want to pay that cost, right? Unnecessarily. Okay, maybe two more questions, right? One, I want to kind of round up that whole geopolitics thing, right? Because I think it was George Yeo that was saying, like, all these finance people, they are mispricing geopolitics, or they are not pricing it properly. Things of the past, will not be the same for the future. Something like I rephrase that. Don't. Essentially, long and short of it, that's what he's trying to say, right? Where a lot of the finance people are underpricing or mispricing geopolitics, right? Where even the data sets of the past 100 years built on the story of a hegemon, right? Or on the US hegemon. Is there any things to be said about that? From your point of view, like, is it still gonna be the same? Nothing's gonna change there, because you already worked it into the way you look at the markets, or like, yeah, is this whole geopolitics thing
I
just
think markets are always evolving, right? The economy is always evolving. But I think the role of the markets is the same in terms of, we think of the market as that information processing machine, right? So that's why we often don't think about market, say, prices being right or wrong, because how do you even define right or wrong? We think of market prices being fair, right? Because every trade has a buyer and a seller. Nobody is pointing a gun at you and say, oh, you have to sell this, right? So everybody has to come to agreement on a particular price. And then that price is the so-called equilibrium, right, of the market. So in a sense, there will be a lot, right, half the people thinking the price is too high, half the people thinking it's too low. I think our best representation of the potential value of the securities. And then I think if you look at academic literatures, there's things about, certain, how investors are overreacting to certain news and underreacting to certain news. If you do maybe a count of those papers, probably half of them are about reacting, as half of them are about overreacting, right? So I think that also shows that, even though we know that, I'm not saying that every security, every second has exactly the right price. But kind of starting from the market is a good working, assumption, right? I think most investors are better off assuming or better off behaving as if the markets are pretty good.
I think you see the Asian markets turn back. I think all these things are so-called priced into the market, right? Like with geopolitics being more and more uncertain, you already see some of these things happen, right? Flows and all that. So it is what it is, yeah?
We definitely see a lot of, say, quick rebounds. We talk about size value premiums being negative, right? In the US, year to date, they've been really strong. So if you had declared the premiums to be dead and then got out of them, you will miss out on that rebound. So I think that consistency is really the key to reap that award. And I think for investors, good to understand in the end, risk returns are related, right? If something only go up, you need to ask why you should be compensated in the first place. Kind of the fact that you can stick through the ups and downs is one of the reasons why you are compensated with that higher expected return.
Maybe last question about diversification, right? So I know you guys are famous for this, right? Globally diversified, and other people also use this word pretty loosely, right? Everyone believes that they're globally diversified. So it's a very loose term. Like
what is the number you use?
Exactly. So I wanted to give you that stage to say, like, what does it really mean to be globally diversified? Yeah, from your perspective.
Yeah, if I give you a number, that means more than 10,000 stocks, across more than 40 plus countries. And then the reason I start with a number is that I realize when I talk to some clients, when I say globally being diversified, in their mind, 500 is enough.
50 people think they're very diversified.
It's enough, right?
Yes.
And then of course, if you think about some of the indices, right, they are considered diversified. But if you look at, say, MSCI All Country World Index, that's probably 2,000 stocks, right? And then if you look at like IMI Index, that's 8,000. So you can go even deeper than that. So I think there never been a better time for global investors today, because now with the technology, with the infrastructure, you can actually get more than 10,000 stocks in your portfolio at a very minimal fee. And then previously, it's probably not possible. So I would say that, try to hold as many stocks as possible in your portfolio, but there are still stocks that we actually try to exclude from our portfolios. So we kind of be more thoughtful about, you want to be broadly diversified, but then it's not necessarily all stocks are created equal. So there are a subset of stocks, for example, within small caps, that are very growthy, very low profits to speak of, then they have very low expected return. So we show that if you kind of target them and then in a targeted way exclude them from your portfolio, you get a big bump in your expected return.
Like what? Give me a bit more like human terms.
Basically, yeah, I know. We're talking about, small growth, low profitability stocks, and some could be, in like biotech stock or maybe junior miners, those type of those. And then those will be in your global kind of diversified index because they, maybe typically have a size floor and then they just hold everything. We actually try to go deeper because we have the ability and flexibility to trade much smaller stocks in a cost-effective way. So we can go deeper, but we also don't hold everything. So we exclude those with very low expected return. We may also exclude stocks that are kind of recently IPO'd. We wait for them to kind of the underperformance to dissipate. And then we might also be more selective in terms of stocks that are, say, cash merger targets, right? Once your cash merger target, you trade like cash. That's actually hidden cash drag in your portfolio, which you don't want in your equity portfolio. So there's a lot of kind of more nuanced, small implementation expertise that actually adds up. So of course, we often talk to clients about, okay, what is going on in the entire world, those headlines, and what are the big factors. Those are important. But I would say equally important are those kind of implementation details. In the end, we are fighting for every basis point, and then they add up.
How have you outperformed the markets? Just so we, let the people know that, hey, I say all these things. We have all these big teams of people doing all this research. What has your performance look like?
Yeah, so we definitely have a track record we're very proud of. So if you look at, for example, our commingled funds that are in the U.S. And they are investing in different regions, global portfolios, U.S. equities, and so on. So for those funds that are, I'd say, launched 20 years ago, all of them are still around. So the survivorship is 100%. That by itself.
Yeah, that's a statement, because for all of you that don't know, if the funds don't perform, they disappear.
Yeah. They get liquidated, they get merged. And if you look at the industry, more than half of the funds are already not around, right? So the fact that we're able to show that long-term, survivorship is, I think to me, it also shows how we conduct business, right? We're not in the business of providing you that flavor of the week. And then our outperformance rate among those funds is more than 70-80%.
Really?
So, and that is also very different from the industry stat, which is probably in a very minority. I'm talking about 15-20%. Yeah. So I think that long-term track record matches our long-term philosophy and then our long-term research. Of course, I would say that over the short term, you should expect volatility. I'm not saying that we're going to outperform every single year, every single month. But whenever we underperform, we know why that's the case. There's a lot of transparency in terms of the design of our portfolios. We know how to set expectations with clients. I think that has been really important for clients to understand why they should still be confident in the strategies when they underperform. And I would say that even in periods when those premiums are really challenging, because we're so broadly diversified, we have very low cost, low turnover, we still have a portfolio that's very robust and that we are proud of. And I think that speaks a lot to kind of the research piece, but also the implementation side of our expertise.
Okay, great. Thank you for your time with us. If our audience would enjoyed it and they are sold by your philosophy, where can they interact with? How can they find out more?
You can go to our website. We actually now put a lot of public, blogs out there to kind of explain our investment philosophy and our investment approach. And actually, there's a lot of shorter pieces that are about those headlines. With the geopolitics going on, with all the different events, how should you think about it, and how you then come back to the investment discipline. So we try to kind of link to those topical themes as well. So I would encourage everyone to take a look at our website. Of course, then there's a lot of financial advisors or digital platforms we work with, so they can be a good resource for them as well.
I hope that kind of puts out some of the anxiety that people are experiencing. I think headlines always drives a lot of energy, a lot of concerned, like how do I do this? What is it gonna change, and all that stuff. Ultimately, it brings back down to your investment philosophy and your strategy. Right? As long as it stands, there's some reason to this thing, then well and good. But of course, Wei would say that it must be backed by research, right? We have a whole team of, which is fair, right? It's a very fair statement. So
maybe I should end with what our founder David Booth liked to say: the most important thing about your investment philosophy is that you have one that you can stick with.
I like that. Yes. Thank you. So with that, I hope you enjoyed today's episode. If you love what we do at The Financial Coconut, head to thefinancialcoconut.com to put your email address so that we can route out the algorithm to reach you directly when we have an event or we have something that's going on. With that, I hope you enjoyed today's episode. We'll see you next week. Meanwhile, take care. Bye-bye.